Through the end of April, nearly 20% of U.S. REITs had held secondary equity offerings. We're joined today by Marty Cohen, co-chairman and co-CEO of Cohen Steers Capital Management, to discuss the trend towards re-equitization in the REIT market. Marty, thank you for joining us today.
Great pleasure.
What do you think is driving the flood of equity offerings so far this year?
Well, let me give a little bit of history and why this has been so crucial for this industry. We've had a bear market in stocks in general, but a particularly severe bear market in REITs. That bear market had two phases. The first phase was one that began in 2007, and that was basically the market's anticipation of a slowdown in the economy, maybe a little bit of overvaluation of the REIT stocks, and that was probably well justified. The second phase, however, was one that was devastating, and that came in the fall of 2008, because while a weak economy might have presented some earnings risk, the collapse of the credit market essentially introduced solvency risks to this industry. The financial risk had to be taken out of these companies, because without assurances that they could continue to operate, then the equity could be worth less and less. As a result, it has been our belief that REITs needed to raise capital in any way they could. The most efficient way would be through selling stock in the companies. And once these offerings got underway and they were priced right and they were sized at a level that would essentially alleviate any financial problems and ensure survival, that would have a very positive effect on those stocks. And that's exactly what happened.
Marty, if we could touch on something that you mentioned, generally these secondary offerings are dilutive and have the effect of pushing share prices down, yet what we've seen so far with REITs is that share prices have increased. Can you tell us a little bit more about this?
Well, there are a couple of reasons why the share price has increased. One is that the stocks are cheap to begin with, and they were priced at a discount from the marketplace, so that it basically engendered a lot of demand on the part of investors. It started with the REIT dedicated investors, but as the sense of a bargain began to permeate the market, many more investors jumped in. So the demand was created by virtue of pricing, which was number one. The second thing is, as I mentioned before, these equity offerings ensured the survival of these companies. So the fact that they may be dilutive or not, but for the new investor, they were very attractive. And the fact that by buying shares in that company would ensure that it survived, that was the most important thing. So we created a lot of demand as opposed to an overhang of supply. And that's a critical factor.
Marty, what do you expect that REITs that have issued equity will do with this new capital?
Well, I think the first phase has been to use that capital to improve their balance sheets, get their balance sheets in order, and take care of maturing debts that they were facing over the next 2 to 3 years. And I think the companies that have sold equity have pretty much taken care of any visible debt maturities out to 2012. Our expectation is that by 2012, credit markets will have opened up, the economy will have gone through a period of greater strength, and we're not concerned about any debt maturities 3 years out. The next phase of equity issuance, I believe, will be one where these companies are able to take advantage of opportunities. Barely a day goes by, recently especially, from Warren Buffett to Ben Bernanke, who are saying that the commercial real estate industry is the so-called next shoe to drop. Well, the fact that REITs have demonstrated their access to capital, and it's not just equity, some REITs are now raising debt capital as well, that enables them to take advantage of whatever opportunities present themselves in a depressed or oversupplied for sale real estate market. And it could be properties for sale, it could be mortgages for sale. So the next phase of equity issuance will be to take advantage of those opportunities.
Cohen Steers has been a buyer in a number of these offerings. Do you think that this new wave of equity suggests a turnaround in the REIT market?
As far as the securities are concerned, I think it is a turning point. And we've seen this in previous cycles where well before there's an upturn in fundamentals, the securities are better valued and you get a bull market in these securities. We think that early March lows are the lows for this cycle, and based on our experience in other cycles, you could have another 12 or 18 months before there's visible improvement in the property cycle, but by that time REITs will have done extremely well.
Thanks, Marty. For more information on this and other REIT news and analysis, check out REIT.com.